What if there was a hypothetical banking concept that gives you more security, protects your money against inflation, gives you more accessibility to your capital, gives you tax-free growth, and gives you uninterrupted compounding? How much control does this give you with your money? It makes sense that you would have more control. And it exists. This concept exists, and it's called, what is a bank? By definition, offers loans and provides financial services. Some types of banks, you have commercial banks, you have savings banks, and credit unions. What are some functions of a bank? So it accepts deposits, it provides savings accounts, some credit products like a credit card, line of credit, things of that nature. And some banks offer financial advice as well and provide wealth management as well. Here's a question for you all. Why do you use a bank? So this is ranking based. So let's see which answer shows up at the top here. That's what I was programmed to do, seems to be at the top. And I don't know where else to put my money is a very close second. When you think about why you use a bank, that's pretty much why. There isn't much else to use. And that's kind of what we're programmed to do. We're programmed to put our money into a bank. Back in the day, our ancestors, before banks existed, they would use a private safe or find other places that were quote unquote safe to put their money in. But in today's day and age, we're programmed to use a bank, especially now with everything going digital for the most part. We are so used to just opening a bank account and that's where our money goes right away as soon as we earn some. We don't even think twice about it. Why do you save? What is your reason for saving money? We save our money for all these reasons. This is why we put our money into a bank, right? It's because we want to save it for whether it's protecting your capital, whether it's for emergencies, big purchases like vacations and cars and houses, even retirement purpose or to supplement your retirement, right? Or passive income, as we like to call it, for investing, right? Before you invest, you have to save the money. Before you do anything financially, your money has to be saved somewhere. That is the main reason why you use a bank to save your money, because you have to park it somewhere. Your money needs a warehouse. Now, what are some problems with your current warehouse, aka your bank account? So let's talk about inflation, the silent assassin. So what you see here is a chart, and the source is at the bottom there, and it shows what inflation has been like since the early 1990s. So as you can see, it fluctuates, but you can fair to say that's around 2 to 3% or 2 to 2.5. And yes, in the last couple of years, it has been crazy. And you can even argue that the prices of certain items and goods and services are far more than the percentage that is shown on screen, especially in the last couple of years. Now, think about your savings account. Does your savings account keep up with inflation? A lot of no's. When you think about the interest that you earn in your savings account, it's fairly low. I know it's been high in the last year or a couple of years, even due to the increase in the interest rates. But prior to that, especially when COVID happened or even before that, interest rates were fairly low, where the rate that you were earning in your savings account wasn't even keeping up with inflation. Some other problems, pesky maintenance fees, right? We all can attest to this, paying the $5 to $20 just to have a bank account open. And then you got your transaction fees over that as well, if you need to do some additional withdrawals, things of that nature. Accessibility limitations. I think we've all been there where there's been a limit on how much we could take out on a daily basis, right? And this is our money that we're putting in the bank. It's our money, but they tell us how much we can take out. I think there's something wrong there. Taxable growth. So the interest that you earn in your savings account is taxed or can be taxed, and you generally receive a T5 in the mail that would show you what your potential amount is that you need to file taxes on. So there's a recap. So it doesn't keep, when some of the problems with your current warehouse is it doesn't keep your money up with inflation, maintenance fees, limitations on accessibility, and taxable growth. Oh, wait, there's more. There are some other problems that you may not have considered. Now, here's a question. It's your bank account, but is it your bank? Absolutely not. It's your bank account for sure, but you're not the owner of the bank. Someone else is. What happens when you use the money for anything that requires money? So when you utilize the money from your savings account, what happens to it? You lose control of it. That happens for sure. Because the minute you spend the money, no matter what you spend that money for, whether it's an expense or an investment, you're losing control of that money. The money is in the item that you or the service that you purchased, or it's in the investment. You don't have control of the money. You control the item or the investment. It stops earning interest and the compounding stops. So the minute the money leaves your savings account, it's no longer going to generate any interest. You've effectively halted the compounding that began when you put your money in there, and your bank account depletes. The minute you take out the money, your bank account depletes by the amount that you took out. Yeah, so after looking at the problems that your current warehouse has, how much control does this give you with your savings? Does it give you less or more control? It gives you less control. And one thing's certain, you are here because you realize that you want or need more control with your savings. You want to find another way. So the type of warehouse that we described, the bank account, it exists within the idea of traditional banking concepts. So the way we traditionally bank, the way we've been programmed to, that's the idea in which this type of warehouse, a bank account, a savings account exists in. The savings account is simply the warehouse used to implement traditional banking concepts like saving, spending, and investing. They're all banking concepts. So it's really the traditional banking concepts and system that limits your control of your savings. So if you want to change your savings and gain more control on your money, then what you first have to do is change the way that you are banking. So you have to change the process of banking. What you see on screen now is the 4 players involved in the banking function, the process of banking. So there's 4 players. This is straight from the book by R. Nelson Nash, The Infinite Banking Concept, Becoming Your Own Banker. The first one is the depositor, which is the person that simply deposits money into the bank, which you all are familiar with. The second person is the borrower, the person that chooses to borrow or take out a loan or access a line of credit, any sort of credit, that's considered borrowing. The third player is the banker. So the banker is the one that facilitates the transactions and controls the rules of the banking function. And then the bank owner is the individual or entity that owns the function itself or the bank where the money is stored. So next question, which characters are you today? Are you the depositor, borrower, banker, or bank owner? So if you're not practicing infinite banking today, then the 2 players that you are is the depositor and the borrower. Because as you mentioned in the earlier questions, you're not the banker or the bank owner. If you are practicing infinite banking, and I'm assuming those are the ones that answered bank owner and banker, then yes, you would be all 4 players. Which of these are the most important? Is there any one of these players or characters that is less important than the other? All of them are important. They all serve a purpose within the banking function, right? The banking function cannot happen without any one of these characters or players. You need all 4 of them for the banking function to take place. Think about when you put money in. There has to be a bank or some sort of entity to put the money into, right? That needs to be owned by someone, then it's the bank owner. And then there have to be some rules in place to make that happen. That's the banker, right? And then when you take money out or you borrow against your money, for example, that would be, you'd be considered the borrower there. No one is less important than the other. If you want more control though, you have to be all 4 of them. You can't just be 2 of them. You have to be all 4 players in order to have more control over the banking function and conversely, your money. So what's the alternative? How do you become all 4 players? How do you gain more control? What if there was a hypothetical banking concept that gives you more security, protects your money against inflation, gives you more accessibility to your capital, gives you tax-free growth, and gives you uninterrupted compounding? How much control does this give you with your money? Yeah, more control, right? Just based on those concepts, right? We're not even talking about anything except a hypothetical scenario with those particular concepts right here. It makes sense. It makes sense that you would have more control, and it exists. This concept exists, and it's called the infinite banking concept. So the infinite banking concept was created by Mr. R. Nelson Nash. He's the founder and creator of this concept. We all owe him a debt of gratitude for putting this out into the world and giving us this opportunity to not only implement this wonderful concept, but to spread it with other people as well. And if you want to learn more about the man behind the message, then I encourage you to visit nelsonnashfilm.com. So click that, bookmark it somewhere when you get some time. Please give that a watch. When you practice infinite banking, you're changing the way that you are banking. And just like when you practice the traditional banking concepts that you're implementing today, you use a specific tool, and that tool happens to be a bank account, right? When you're conducting banking today. So when you practice infinite banking, you need a specific tool for that as well to implement it. And that tool is a participating dividend-paying whole life insurance, which is a type of whole life insurance. Now, again, we're talking about whole life insurance here because we need a tool to implement the infinite banking process or the concept of infinite banking. And that's why we use it. The specifically designed whole life insurance policy has the features that mimic a traditional bank account and more. There are more features and benefits that you can get out of it. These factors are important. And then what you'll notice is right at the bottom, there are some 2 bonus benefits. One of them is access to capital on your own terms. And the next one is tax-free death benefit to your beneficiaries. That's something that you don't have today when you use a regular savings account. It is essentially a private banking system disguised as whole life insurance. And that's why we use it. Would having these features give you more control over your money? The majority is saying yes. We need to understand whole life insurance a little better in order to understand how we can use it for infinite banking. So there's 4 main components that you need to remember when it comes to understanding or participating dividend-paying whole life insurance. The first one is premium. So premium is what goes into the policy. It's the deposit essentially, right? The same way you deposit money into the bank account today, but you're going to be depositing money into the whole life insurance policy, which is your new warehouse now. That deposit is called premium. That's the insurance term for it. But to us, it's a deposit, death benefit. So this is the money that's paid out tax-free when the person insured becomes an angel. Cash value. Cash value is your living benefit. So death benefit is something that your beneficiaries or your loved ones receive when you become an angel. Cash value is something you can access while you're alive, hence why we call it the living benefit. It's your capital. It represents your capital. And this increases in value every single day, tax-free growth. We're going to dive more into cash value, but that's a basic understanding of what it is. Dividend. When you have a participating dividend-paying whole life policy, you get to participate in the divisible profit from the insurance company. And this is paid out once a year in the form of dividends. Key concept number 1. Remember that term cash value? That represents your capital. A symbiotic relationship between the death benefit and the cash value. One does not exist without the other. This cash value, it grows every single day. And there's a reason why it does that. And it has to do with a contractual guarantee that is built into these particular life insurance contracts. The contractual guarantee is by age 100, the death benefit and the cash value must match. So because of this guarantee, the insurance company is obligated to grow your cash value. This is why it goes up. So remember, we're not talking about how they're growing it. And because of this contractual guarantee, what happens in the outside world doesn't have as big an impact on the growth of your cash value. The cash value cannot go down. And that's just the nature of the contract. Because remember, it is a contract, not an investment. Let's look at key concept number 2, accessing cash value. So when it comes to accessing cash value, we don't withdraw it. We simply borrow against it. So when you withdraw cash value or when you withdraw anything, for example, your savings accounts that you use today, when you withdraw the money, you are stopping the compounding. You're effectively halting it. So if we did that with our cash value, then we might as well just have a savings account because you're stopping the compounding. However, when you borrow against your cash value, the cash value continues compounding. It continues rising as you borrow against it. So in this case, you won't be interrupting the compounding. You're just going to let it keep growing as you access capital. Everyone knows compounding is the eighth wonder of the world, as the world calls it. But it's only the eighth wonder of the world if you do not interrupt it. The minute you interrupt it, it's not so wonderful anymore because you stopped it. So you need to let it keep going. And that is why we borrow instead of withdrawing. Now, I know when I use the word borrow, your existing mindset, your existing paradigm is not liking that word. Because when we hear the word borrow, we think of loans. And we don't feel good when we hear the word borrow. But I'm going to encourage you to embrace that thought and put it aside for a second and keep your mind open as I keep going forward. So let's talk about how we borrow against our cash value. So it's a process called the policy loan request process. These are the two main questions that the life insurance company asks you. How much do you want based on the cash value available? And how do you want to receive it, whether it's direct deposit or mailed check? Here are some important facts on policy loans. So when it comes to policy loans, when you borrow against it and you receive that policy loan, which is money that you get to use, it's not your money that you're receiving. It is the insurance company's money that you receive. And what is happening to your money? It's still in the policy in the form of the cash value, compounding every single day. When you take out policy loans, it doesn't impact that daily cash value growth. Very key concept to remember. And it doesn't reduce your death benefit while alive. It doesn't negatively impact your future dividends as well, nor does it show up on a credit report. These are private loans. It's like individual to individual, or in this case, individual to an entity. It doesn't show up on anyone's radar. Government, CRA, none of that. At death, outstanding policy loans, if there is a policy loan that is outstanding, it simply gets deducted from the overall death benefit. And then the remaining death benefit is paid out on a tax-free basis to your loved ones and your family. Here are some infinite banking rules when you access a policy loan. When you access a policy loan, you always want to have a plan to repay it. You always want to have a plan to repay your policy loans. The interest accrued on the loan is essentially covered by the cash value growth. So your cash value growth doesn't reduce. Your access to it reduces because you have a little bit of interest accruing on the loan. However, the growth of the cash value is covering that. And now as you make repayments, you get access to the same money again because it's going back to your own system. If your cash value grows $5 per day and the interest that is owing on the policy loan is $2 per day, how are you doing? You're moving ahead. You're ahead by a net of $3. So this is what I mean when I'm saying that your cash value growth doesn't reduce, it's just your access to it reduces. Because now if you wanted to access that cash value, you have a net of $3, you can access that $3. Okay? But the $5 is still there because now when you repay the $2, you get access to the entire $5. So when it comes to the traditional banking tool, which is your savings account, the deposits grow as per the interest rate, and the interest rate is determined based on what central banks determine the rates are. And that has an impact on how much interest you receive in your savings account. There are times when it doesn't even keep up with inflation. When we look at the infinite banking tool, which is this whole life insurance policy, we are converting our cash into cash value. And by doing that, the cash value has to match the death benefit. The premiums are fixed amounts of cash that converts to more cash value over time. So every year that you put in that fixed amount of premium, you're actually getting more over time every single year in the form of cash value to access. And over a period of time, it can keep up with inflation. If your maximum premium for your policy was $10,000 per year and you got more than $10K as cash value to access, isn't that a good thing? It's not going to happen in year one. It'll take some time. And typically it happens around year 3. And then year 3 onwards, you're getting more than what you put in. Security, something else we talked about or alluded to at least, gives you more security. How? When we look at traditional banking, the traditional banking tool, the savings account, it is CDIC protected. And what exactly is protected? And you can actually look up those resources I have on screen, and you can see for yourself that you are protected up to 100,000 of checking, savings, or GIC at each member institution. Nothing more than that. Also, your money cannot be invested. So if you have stocks, if you have bonds, that's not covered under CDIC protection. And you can verify that in the link. Now let's look at the infinite banking tool, which is the whole life insurance policy. It's Assurance Protected. So Assurance is an organization, just like how CDIC is an organization. Assurance protects the policy owners. Again, there's a link at the bottom there for you to do your own research on it. And what is protected? Any whole life insurance, okay? Because we are focused on whole life insurance. So whole life insurance is protected. What is the protection? It's up to 100,000 or 90% of your cash value, whichever is higher. I'll say that again. Next, protection of up to 1 million of death benefit or 90% of what you have. Again, whichever is higher. So we have savings account on one side and we have the whole life insurance, which is the tool we use for IBC, for practicing infinite banking, on the right side. So on the left side, starting with the savings account, there's no death benefit. So whatever you have in your account, when you become an angel, that's all that gets passed on to your family. Whereas when you look at the tool that we use for IBC, because it's whole life insurance, there's death benefit. And that death benefit is paid out tax-free at death to your loved ones, which is, in many cases, multiples more than what you put into it. When it comes to savings account, your money grows via the interest earned. It's interest rate dependent. When it comes to whole life insurance, money grows via cash value growth. And it's based on that contractual guarantee that it cannot go down. With savings accounts, there are no dividends because, again, you don't own anything, right? You don't own the bank. Whereas with whole life insurance, there are dividends distributed. Again, very specific whole life insurance, in this case, participating dividend-paying whole life insurance. Not every whole life insurance distributes dividends. Maintenance fees. Savings account has various maintenance fees that fluctuate. With whole life insurance, yeah, there's fees, but it's built into the premium. And all this is stated in your contract when you get the policy. It is never going to be in addition to your premium. Accessibility limits. There's limitations on how much you can withdraw, how much you can transfer. When it comes to utilizing whole life insurance for infinite banking, your access is based on the amount of cash value you have. If you have enough cash value in there, then that's how much you'll be able to access. The growth that occurs via the interest earned in the savings account, that is taxed. The growth that occurs with the cash value is tax-free. With the savings account, someone else is the owner of the bank. You just have the bank account. Someone else is the owner. With the whole life insurance policy, you are the owner of the policy. The insurance company simply services it. You own the contract outright. They are simply servicing the contract. When you withdraw, compounding interrupts, right? It halts and your savings account depletes. When you access money or capital from your whole life insurance policy, you use policy loans against the cash value. So the compounding never stops and the cash value continues growing as if nothing happened. Whether you take out a policy loan or not, the cash value is going to grow because of that contractual guarantee. Death benefit must match cash value by age 100. Knowing this, does this give you confidence that when you practice infinite banking, you are all four characters: the depositor, the borrower, the banker, and the bank owner? Amazing. Regardless of what you do financially, whether it's spending or investing, your money has to be saved somewhere first. So why wouldn't you save it in what we just discussed when it comes to infinite banking and utilizing the whole life insurance as the tool for it? When you save money, this is what happens. I'm going to hover my mouse here. You should see my mouse. So you start where you start, and then you're saving for whatever it is that you want to save for, right? The reasons that you gave earlier. You save, you save, you save, you save. You reach your savings goal. What happens next? You use the money for whatever you intended to use that savings for. And then your money comes all the way back down, or so I should say your account drops all the way back down. If you use all of it, it comes back down to zero. And then you focus on the next goal that you're looking to save for, and then you build it back up again. You work harder, maybe you change jobs, maybe you get some additional sources of income, and then you build it back up, and then you spend it again or invest the money, and then it goes back down again. And then you build it back up. This is the life of a saver. Yeah, this is the cycle of a saver. This is what you are probably familiar with. Let's talk about a borrower. When you look at borrowing money, it's actually worse because you are going below zero because you're accessing someone else's capital, and then you're making your way back up again by paying it back. And by the way, who's getting all the interest and the payments? the other person, the other lender, and then you're back to zero. And then maybe you borrow again, and then you're back to zero again. This is the life cycle of a debtor or a borrower. Here's another brain tattoo that you have to sear to your brain. When you practice IBC, this is what happens. This is the image you want to think of. On the left side here, we have the starting point. You started your policy. Your cash value starts growing. The green dotted line is your cash value. It goes up, and as you can see, it curves as you go closer to 100, indicating exponential growth over time. As that grows, you get to access it by borrowing against it. Remember, you never want to interrupt the growth. So you access capital in the form of policy loans, and then you repay those policy loans. You always want to have a plan to repay your loan. Don't steal the peas. And then you're back to paying off the policy loan. Notice how when you've paid off that first policy loan, you're not back to where you started. You are further ahead. So not only will you have access to everything you repaid, but you're also going to have access to the growth that has occurred. And this is what you would be doing when you practice infinite banking. And as you age, there's only going to be more and more for you to access. Here's a question. How much money would you not put into your infinite banking system, knowing all this that we went through? Regardless of your answer, you should commit to one thing, and that is to learn more about this. And the way to do that is to get in touch with us. And you simply text schedule to the number that you see on screen. If there was a chance that a call with our team could enhance your financial future or your well-being, how would that make you feel? Yeah, fantastic, hopeful, happy, better, freedom, peace of mind, safer, amazing. And all you got to do is pick up the phone and have a conversation just to see where you're at and what's possible. Ask questions, because that will lead to clarity. And then once you have clarity, you'll have confidence on what to do. So in many cases, what you hope to learn by reading books or listening to podcasts can only be learned by attempting what you fear. Some knowledge is only revealed through action. I'm doing this because many years ago, I had a fear of what to do with my life. I didn't have much purpose. And by putting myself out there and taking action on the books that I read, the people that I met, the podcasts I listened to, the videos that I watched, it helped me gain confidence and skills to get to a position where I attracted the opportunity to work with Ascendant Financial to help spread this message. But had I not taken that action, nothing would have happened. To know and not to do is like not knowing at all. Now you know that there is another way to save your money that will enhance your financial future and well-being. You don't have any excuses now. So you have to take the action needed to add a better warehouse, a better option to saving and growing your money. The problem is not the banks. The problem is your dependency on the banks. You are dependent on them. Create more options. That's what this allows you to do. By implementing infinite banking, you're creating more options for you and your family. So become an infinite banker, become a wealth creator, and take control of the banking function, your money, and your financial well-being.
In Canada, how do you take a loan out against a policy without involving a bank?
Some of the insurance providers that we use here in Canada, they have the ability to provide policy loans from their own pool of capital that they work with. So you don't need to interact with a bank in this case to access the funds. You can do it directly with the insurance company.
Most of the time you need a bank account to put that money in and then move it to where you want it. So you still end up needing a bank account for the convenience of debit or checking. That's all you need. So you still end up using a bank account. You just don't use the other features at the bank, like the borrowing feature and all those things. So you get away from those elements, but you still need somewhere to put your money.
How do I get more money to pay for a policy more effectively? Get in touch with your coach and he will actually show you how. There is a way of doing it. You don't have to have a lot of savings to start this. If you do, you may be a little further ahead, sure. But if you don't, that doesn't mean you can't start. It's not so much important as to how much you start with, but it's important to start. Because when you start, you get that compounding started. And then you can actually design your policy in a way that can accommodate for more capital as your income increases, as your savings increases over time.
Why not other types of permanent life insurance?
What I would encourage you to do is to read the book, The Infinite Banking Concept by Nelson Nash, and he explains exactly why we work with permanent life insurance, specifically participating dividend-paying whole life policies. And it's simply because they have the best features, if you will, that allow us to use it for the purposes of infinite banking. Yes, there are other types of permanent insurances available, but they don't have the best features to allow us to use it for infinite banking. And I'm talking intangibles. I'm not just talking growth. I'm talking about control. I'm talking about having ability to take out policy loans, put it back, have your cash value growth being uninterrupted, have your cash value growth based on a guarantee rather than an investment. So those are things that participating dividend paying whole life policy has that other permanent types of insurances don't. Why multiple policies is best versus one large one. Well, it really just depends on your situation. If you have the ability to start a large policy, then that's the way to go. Or maybe you're in a position where you can insure other lives in your family. Maybe you have wife and kids, partners that you could protect as well. And so in that situation, you may choose to have a system of policies. And as you get more familiar with the concept, you will learn that it's not just about having one policy. It's about having a system of policies. Every one of us, we don't just have one policy. We have multiple policies within our system. We open it up for different reasons. One is maybe we want to insure another life and we want to do it this way. Or another reason could be our income increased and our existing policy capacity is maxed out. And so we need to open up another policy to accommodate for more income. Those are some reasons why you would look at opening multiple policies.
What are the qualifications to buy a policy?
There's a few factors that the insurance company looks at, right? So when it comes to getting these policies, the insurance company is underwriting risk, right? They're assessing how much risk you bring to the pool of capital that they control. So some of the things they look at is mainly your health, right? They look at your health. So it pays to be in good health, obviously, when you're applying for life insurance. They also consider age as a factor. And they also look at finances as well. Those are some of the factors that they consider when it comes to qualifying for life insurance.
So if one takes a policy loan, an example, 400K, have this deposited in their bank checking account, how does one explain to the bank where this money comes from? And why should it not be deemed taxable income?
I typically don't get those kind of questions when I deposit money in the bank, but if somebody asks, I would just simply tell them. And it's not deemed taxable because it's just not. It's money I have somewhere else that I got access to.
It's not like you're doing anything illegal.
They're just another financial institution, actually, when you study life insurance companies.
How do you become an IBC practitioner?
Well, what you can do is you can start at a website. There's a careers page and take a look there and see what interests you and start there.
That's a great place to start. And then obviously there's a course to take and a mentorship to do, but it's a great journey. And I encourage anybody that's got a lot of interest in it, just to look into it.
All the advisors on our team, we're all life licensed and we all have our infinite banking practitioner certification with the Nelson Nash Institute. And we've gone through mentorship and lots of studying to get to where we're at.
Are there any restrictions on who you can take a policy out on?
You have to have insurable interest in that individual. So there has to be a reason for you to take out insurance on them. Because I know we're doing this for the purposes of setting up our own private banking system, but the insurance company, for them, it's still life insurance. So you have to have a reason as to why you're taking out insurance on that person. Some easy examples are family members. It's fairly easy, right? Insurable interest or your family, joint venture partners, business partners. It cannot be Joe Schmo down the street. There's no insurable interest there unless Joe Schmo is a partner, a business partner, or joint venture or something of similar. So that's what I mean by insurable interest.
What's the recommended frequency of deposits? Annual, quarterly, monthly?
When it comes to the life insurance policies that we work with, the two options that you get is annual or monthly. There is no quarterly option, at least none that I know of. And it's recommended to do it annually. However, depending on your situation, if your cash flow doesn't allow for annual, then monthly might be a viable option as well. So it's whatever works for you. And you can always switch it from annual to monthly or monthly to annual, even after setting it up. It's flexible to your situation.
What is the maximum number of policies I can have on myself?
That depends on your need for insurance. So as much as your need for insurance will allow for. What is need for insurance? That is a number that the life company looks at based on your assets, liabilities, primarily income. And based on that, there's a factor that they look at that determines how much insurance you should be getting. Because at the end of the day, when you look at insurance, it exists to protect loss of income, right? And so it's not just loss of income for a year, it's loss of income for the years that you'd potentially be working for, right? And so that would determine what your need is. So obviously it varies based on your age as well, the factor that they look at. And so whatever number that is spitted out from that formula will determine how much insurance you can get.
And how many retirees usually are practicing IBC?
Mhm.
Considering the fact that if you take out a policy loan,
Mhm.
it has to be paid back. Seems like you always have to be working. We have a solution for that, and that's part of retirement planning.
Yeah.
That's something that we do as well. And then there's different strategies, and that's kind of unique to the person and what they want to build and when they want to retire. And there's assumptions that we have to take into account there. So yeah, and that's just talking with a specific advisor. It does get to a point where, yes, you won't be paying back that loan. That's kind of the short part of it.
You can definitely plan it in such a way where when you get to retirement time, or if you are in retirement time, you can plan in a way where you can design a policy where you can access the policy of the cash value, but not necessarily with the intention to pay it back, right? And it's done in a very strategic way so that when you do become an angel, whatever loan balance is there, that's deducted from the death benefit, but there's still some death benefit left over for your family or your loved ones, whoever you're leaving behind.
What's called an insured retirement program that provides tax-free cash flows for that retirement, and it has no implication to your government benefits. So it's with good amount of planning and exploration with your coach, it's definitely something worthwhile to consider.
And Henry, you can actually enhance your government benefits by doing that, right? You can flow it through the system and then take it right back out through the insured retirement plan.
This is the benefit of now implementing Nelson's wisdom and message that we're putting all together.